Good morning. My name is Alessandro Hatami. I'm moderating this panel to talk about one of the more interesting subjects that has come up across the event at Paris Fintech Forum. And it's very much at the center of why we're all here. So it's about valuation and about the value of what we do. Now, the question for the panelists here is, are we living through a bubble? Are the valuations that we're seeing these days realistic? We've seen the latest Plaid valuation. We've saw the Moniz valuation recently. All the challenger banks in the UK, they're getting billion-plus valuations. Are these justified? So the panelists are Benoit, Julien, Creuzé, Julien and Donald. Would you like to introduce yourselves very briefly?
Okay, yeah, that's fine. Thank you. Hello. Good morning, everyone. So I'm Benoit Legrand. I'm Chief Innovation Officer of ING and CEO of ING Ventures. It's a 300 million VC fund, which we started about 5 years ago.
Good morning, everyone. I'm Julien. I'm an investor at BlackFin. BlackFin is a private equity and venture fund, fully focused on financial services. And we invest today only in Europe with two strategies, buyout, which is 1.5 billion under management, and venture, and I'm in charge of the venture team.
And it's nice to meet you as well. My name is Don Butler. I manage a venture fund that's a $500 million fund called Thomvest Ventures. If you know Thomson Reuters is majority owned by the Thompson family, and this is the younger son's private venture fund, and we do primarily fintech investing.
Thank you very much. So I thought the good idea would be just let's jump into this. Are we in a bubble? Benoit, we'll just have to kick it off.
How much money do I get for telling the truth here, right?
Zero.
Yeah, zero.
It's Laurent here.
It's a high risk, immense return, right? So, frankly, the right answer would be, I think, I don't know. But I would say, if prices are being paid, then someone is paying the price for it, right? So someone sees values, but it might be different than the price someone else would assess the company being worth for. So I think you always, in a very illiquid market, you always need to look at what is the value which is in the eyes of the one who puts the money on the table, right? So, and it might be very different from the one you have with your eyes. So, well, it is still, and it has been, and it still will be, I think VC world is a very volatile market. So I don't know whether it's a bubble or not a bubble, but I think you can also be used, if you look at examples like, Adyen, for instance, right? So Adyen is now worth 25 billion, okay? And it's stock listed, right? So, it's just as good as what investors in Microsoft are saying, right? So they're just like liquid. And when they went to they went public about, 2 years ago, I guess, half of the price, people were screaming and say, wow, this is crazy, you should not be doing this. And then when you go back 5 years in history, is the people saying, whoa, it's worth 200 million. I think you're crazy, right? So I don't know, I think if someone feels good in putting some value in a company at the price, I think it's, let's say, the right price, and what some people would say it's the price a fool would pay for something, right? But, whatever. So what is, I think, important is that if you want to play in that game, then you need to be ready also to either go along or stop or focus on something different. But this is how the market goes.
Thank you very much, Laurent. Could we have a less diplomatic answer from you, Julien?
I mean, when I look at a company and I want to invest, obviously I say that we are in a bubble and that their valuation expectations are way too high.
So that's a marketing tool, is it?
But when I'm on the other side and with portfolio companies trying to raise the next round, obviously we are looking for higher valuations. So no, I think, clearly valuations are high today compared to how they were 3 years ago. And we see the valuations going higher and higher every year. So, valuations are high. Then the definition of bubble is high valuation and increasing valuation, but also for assets that do not have the tangible value. And when we look at the financial services, I did the exercise this morning. If you look at all the banks in the world, their market cap is $7,000 billion, 7 trillion, $7,000 billion. And when you look at the market cap of all the fintech companies, it's only something around 150 billions. So the fintech companies are representing 2% of the market cap of the banks in the world. And to be fair, we are under a major transformation of regulatory, tech, you look at the tech of the banks, you look at the tech of the startup companies, I mean, just like not the same things. And customer expectations. So there are so much transformation that I'm convinced that fintechs over time can take a bigger chunk of the market cap of banks. And clearly, I mean, high valuations, the companies will have to demonstrate their growth. Some will succeed, like Adyen, like Plaid, like many others. Some will not. This is part of the game. If you are an entrepreneur, like raise now because there are money on the markets, but then you have to deliver very fast and at a very good pace.
Thank you very much. Donald, what do you think?
And so we're primarily investing in Silicon Valley, and you know it's kind of a pernicious question, I think, because if you look at it, I think we are, but this is very different than previous bubbles. And to put it in perspective, when I first started working with Peter Thompson was February of 2000. So we've been through a couple cycles now, and we've seen how previous bubbles worked. And looking at this one, you know, if you define a bubble as like a rise in asset prices, not tied to the fundamentals, driven by irrational exuberance, I think we've definitely had a rise in asset prices, but it's a 10-year rise in venture. And if you look at it, in the last 10 years, Series A in Silicon Valley, Series B in Silicon Valley, the amount of money being raised has doubled, and the pricing has doubled, in some cases more than doubled. So it's a long, pernicious rise, sometimes tied to the fundamentals of the business, sometimes not. And then I don't think it's driven by irrational exuberance. I think you might see deals where you look at it. I was meeting with people at Visa just after Plaid got announced, and you know, a friend of mine who's over there, senior manager, he's like, "Don't ask me about pricing. Don't ask me about the multiple. You know, I can't defend it." But so you might see transactions that look irrational, but I think in this case, it's more structural, and frankly, I think it's driven a little bit by desperation, and the desperation is large institutional investors looking for yield, looking at the venture class, and pumping a lot of money into this class. And so, like, I don't expect a big bubble to pop because there's too much money sitting on the sidelines waiting to be invested, and I think that'll support pricing regardless of what happens.
So that's interesting. So you're saying that there isn't a bubble, even though there's a lot of partially irrational money floating around.
No, I'm saying there is a bubble, but it's hard to recognize because it's been such a long, slow economic expansion.
So it's interesting because I also lived through the dot-com bubble in the year 2000, and when pets.com came out, everybody said, obviously, everybody has a pet. If you only had 1% of the market, it would be a huge business, and so on. Some of the same rhetoric is being used right now. Now, the difference between the bubble and the dot-com bubble and this bubble is the dot-com bubble was very much driven by consumers and investors, individual investors, so there were lots of IPOs happening, while right now it's a lot of private investors happening. So, Laurent, can you give us an idea of what are the sources of this huge flux of interest and investment into fintech? Because it's obviously not IPOs.
Nor ICOs, right?
Nor yet.
Yes, I think obviously the interest rate curve, I think the liquidity, I think those are, basic things. But if you go beyond those macro trends, I think there's also an acknowledgement between players in the banking and finance industry that things are really getting different than they used to be. I think maybe they have survived a couple of cycles before, but I think this change which we are facing now is fundamentally re-changing and reshaping the way they are doing business. And I think it brings the fundamental question, which I say, you know, I've been there. I was the CEO of ING here in France, and IG Direct. I've been there for some years also, and I was also in the internet times. But I think for the first time, I see, you know, at highest positions in banks, the awareness coming and say, oh yes, you know, this is a tsunami coming to us, right? But I think we thought it was only in theory, but I think they see it and they take the measure of it. And if you go deep, you know, to the kind of figures with Julien was mentioning, then you see immediately the size of the problem and the opportunity also on the other side. And in a world where, you know, the winner takes it all, you know, well, 1 billion in a company can be 100 times too much, but I think it's 10 times too less, depending of is going to be the winner, because the opportunity is just like huge. So I think we somehow navigating in the mist, and we're just like in the fog. And well, we'll have to go through this. But the real change, I think, is that banks are now really understanding that there is a big change, and that they have to do something, and that sometimes, you know, it might cost less to pay this kind of price Visa is paying just to, you know, cross over the bridge. and use the power of their brands and distribution, because that's also something we should never underestimate, is the power of, you know, those guys, you know, the incumbents, right? They're there, right? You can say they're lousy, they're, you know, they're bad, they're not fair. You can say whatever, yet, you know, they have half of the market, right? So, and any Apple Pay coming, any other payment, you know, goes through a card, right? So I think let's not forget that those changes take very long time to go through. And, you know, just don't want to be too long, but maybe just one more thing. When I was, you know, 20 years ago, I was managing a partnership between ING in Belgium and British Telecom, right? It's called UCOM. And and British Telecom was giving the internet access because, you know, the internet bubble, and ING was giving a payment wallet, right? 20 years ago, right? It was, you know, technology was there just to do it, but it never flew because it was just too early. And now, you know, 20 years later, so I wouldn't say it takes 20 years to get all those changes, but I think technology is going really hyper fast, but we as human beings are really stuck into, you know, the unwillingness to change. And I think we need to manage both. And in the meantime, you need to invest in those fintechs and put money just to go through the cycle.
Thank you. That's very interesting. So we talked about the incumbent and how the incumbent are affected by fintech. And in a funny sort of way, there seems to be two types of incumbent. And a bunch of incumbents, like I will put Visa in that, which actually see fintech as a fundamental challenge, and therefore they're investing heavily to make sure that they're still a player in that space. And then you see all of the big banks, and they are all investing heavily in generating all equivalents to some of the fintechs that we're seeing there. And you see them invest, but they're not investing in gigantic ways. So the biggest investments that you see in single deals are maybe some of the Spanish banks, BBVA buying a bank here and there, but they're spending hundreds of millions. They're not spending billions, right? ING also.
ING as well.
Of course, ING. Of course, ING.
Do better marketing.
Of course, ING. Of course. Sorry. All due respect, Benoit. There seems to be on one side there's a fear of missing out, fear of being destroyed. In fact, I think some of the discussion, the reason why Plaid is so interesting is because it's looking at APIs between banks that could potentially lead to a place where the schemes are replaced by a Plaid equivalent. But then the BBVA investment is just to do a pilot and see if it works out or not. So what are your thoughts about these two mindsets of the incumbents in investing?
Yeah, no, I think it's very tough. I mean, when you look at payments, I think the banks, they totally lost the payment war. And you see Adyen, you see PayPal, you see all these players. Obviously, they lost it.
WorldPay?
Yeah, clearly. And so, so in specific segments, if they don't come in like early enough, there is a risk of losing totally the market. But what's tough also is if they invest too early, they destroy the business. I mean, if N26 or Revolut ads raised from like BBVA or like any other players like too early, giving 20-30% of their capital to bank, they would have been destroyed because of regulatory constraint, because of mindset, culture. So it's tough. You need to monitor. You need to see what's happening. You need to acquire when it's the right time. You need to enter when it's the right time. But you cannot like you cannot create a disruptor internally. It's quite impossible. So it's tough for banks to serve this trend. Yeah, for sure.
I'll have to react to this a bit later.
What are your thoughts, Don?
Well,
We're seeing some irresponsible behavior from some of the big institutions.
Well, and I'm deeply sympathetic. You know, I'll give you a story from somebody I met that was in the big banks, and I feel like they're plagued by their history and all the acquisitions they've done and all the back-end infrastructure they have. And I remember one time we were looking at Simple Finance right before it got bought by BBVA, and you know, I got to know the CEO quite well. We were very impressed with what they were doing. And we also spend a lot of time with banks trying to understand, you know, how they look at the world to get a sense of like what reality looks like outside of Silicon Valley. So we're meeting with like a top 30 US bank chief innovation officer, former chief technology officer, senior guy inside one of the banks. And I walk into his office and there's a whiteboard with all these features of all the things that they want to do in their mobile app. And I was like, holy, you know, oh my God, that looks just like what we see in the product roadmaps for Silicon Valley. And he goes, and he looks at it and he says, yeah, it's a thing of beauty, and when interest rates rise and this place starts to print cash, we're going to backslide on all of it. And you're like, you're going to backslide on all of it? And he said, because nobody's going to want to take the risk to fundamentally disrupt what we're doing at a time when we're reporting really good public results. And so the thing that I wonder about is sort of the organizational incentives to kind of take that risk. Because his view was none of the management team was going to really want to step up and put their careers at risk.
Thank you.
Okay,
No,
but complain now.
No, I think I certainly acknowledge, and I think what you're saying is I think you nail it, because it's just about people and leadership, right? And of course, if you do not have the CEO or the board in place, which effectively genuinely believes that this is the way forward, and then the world is being this way, then nothing will happen, because moving 50,000 people of 100,000 people, I think, in an environment where the ability to change is very limited. I think I completely agree. But then I go back also to what in the previous panel was said by the man, saying it all depends on the people who are there, right? And who you met with, and then what kind of VC you are. So I think you can do those things, but you need to do this a bit adjacently to your own company. I think if you deeply do this in the company, I think it's not going, and I don't want to go back to history, but I think when ING Direct started about 20 years ago, this is something which has been done within a company.
We'll look at ING with lots of respect.
No, which was, raised 400 billion of assets and managed. So I think, and that's something which was been done with 24 million customers, right? So we started with the old, we disrupted the UK aggregation money market, where we have now, way above 1 million users. We took about 70% of the PSD2. So I think is just a question of culture, about the way you look at it, and you can do it. And I think once you can combine both, I think you can do a lot. But I think the majority is certainly not in this way. And I think I'm not sure that by helping or investing too early in the companies, you kill them. I think you certainly would do if you take a majority ownership at the very at the very late stage. But I think minority, as we do in ING Ventures, I think, again, depending on how you're there, you're just like making the life complicated. But I think we do not intervene in their compliance, risk management, where we do not have a majority stake, right? So which is also in line with all regulations. So this is also a way for us just to bring the value of distribution and power. So just a bit to mitigate the point.
I mean, that's clear, but I think ING is not representative of all the banks, and I think you are doing to be fair, an amazing job, as some other players, but yes. as like keeping the company very independent and like really acting as a financial investor and not only a strategic investor.
So ING is doing a fantastic job. So everybody, please acknowledge that I've said that. The question I have for you is, again, going back to maybe instead of looking at the financial valuations, looking at the actual what's been achieved. So if you look, for example, the UK market, one of the ones that's more noisy and more visible. You have a series of challenger banks, and they all come up with 1 million to 2 million new customers that they brought in. Revolut has even over 3. And then you look at the incumbent banks, and they don't tell us that they've lost customers. So what's happening is people are buying these products on top of what they have. And therefore, there isn't an element of pain going to be generated if one of these companies disappeared. But the money's still flowing in, and they're creating all these unicorns. That said, the money flowing in is huge in evaluation terms. It's not that big in the amount of money that is spent in financial services, because the average large bank spends between 1 to 2 billion a year on IT services and technology, of which 75% goes to maintenance, right, as we all know. So the numbers are big, but are they truly huge? Now, I think the question I have for you is that there seems to be an element of exuberance going in this, but maybe it's not justified. How are we going to react if this exuberant, positivistic, and opportunistic approach of the big incumbents suddenly goes away, and we see a repositioning of the market? If we actually see the bubble happening, what will be the effect on, let's say, the fintechs? Julien, do you want to take that on?
Depends on the fintechs. Some of them are relying on the capital they raise every year, and they need this capital to sustain their cost base. They need this capital to like sustain their growth because their customer acquisition costs are very high and unit economics are not so good. These companies, the day it becomes more difficult, it will be a disaster for them because they do not have any backup plan. They won't be able to raise money from new investors. So if their existing investors are not like strong enough they will basically like close.
These are for the companies that have already raised funds. They will find.
Yeah, companies like valued like at hundreds of millions or billions. It can stop from one day to the other. I mean, if you are not able to raise money from new investors and you burn like, I don't know, like 20 million a month or 10 million a month, then like it goes quite fast. So they can disappear. Then there are like plenty of other companies, also fintech companies, I mean, not with the same exact models, that have like better unit economics, that do not rely on new capital injection. And these companies, I think they won't have the same difficulties. Maybe the valuation will go down slightly, but they won't have the same difficulties because if they adjust their cost base, they are able to be sustainable, they can become profitable. So I think you have to differentiate one to the other. The fastest growing ones are on the first parts, are the very risky ones. Then what happens if it goes, if it becomes difficult, like we'll see.
So what you're saying, in the ones that have already attracted investment will probably find themselves not able to attract new investment. And that leaves the investors in those companies thinking, okay, what do I do? Because if I stop investing, this will go bust and I'll lose everything. So they will focus their investment on existing. Would you agree with that, Donald?
Yeah, I'd say, you know, we have several companies in our portfolio that are sort of in the pre-IPO stage. And I would say you've already seen this impact from like WeWork and the other IPOs that have gone public that have not been profitable, that have trended down, that there's kind of this retreat towards quality and sort of a focus on unit economics. And we've already seen that at the later stage. And so I think companies having to prove that they can have a scalable and an efficient business model is already come into the late stage market. And you know, I feel like it still hasn't fully trickled down all the way down to like the Series A or the very early stage companies. I think they're still sort of a combination of like optimism and fear of missing out from the investor base. And so I think we've already seen that impact happening.
Maybe I think when so I was not old enough for the .com bubble, but
you're showing off here, but okay.
But I talk with people and try to get some insights from people that live this bubble. And what I've been told is that the day things start to become like frozen, everything stops like from like 1 month to the other. So because investors, when they feel that their portfolio companies won't be able to raise the next round, won't be able to be acquired, won't be able to go public, when they feel that, they stop investing in new companies, they focus on their portfolio companies. So like really like from, it can stop like from 1 month to the other because like every investor will focus on its portfolio companies. And at this point in time, like if you have a huge burn, it starts to become a big issue because finding new investors will be difficult.
So, Benoit, if you feel then, therefore, that there is a bubble coming, if you're a startup, you should really go to get some fundraising right away, as fast as possible, because if there's a bubble, the new investments will disappear, and the ones that have already received a few rounds will probably get the majority of the attention of the VCs.
Yes, I just fully agree with what is being said, and I also agree with the statement. I think you need to also to go there and look a bit further than the short term. I think you need to secure your certainly 2 years going ahead, making sure that you're not into trouble, because once this is happening, I think now everybody's bullish, but I think 1, 2, or 3 leaders in this market are becoming bearish, then everybody's also turning the other way around. And as you say, it's going to be very sudden. I think that's going to be, it can happen anytime. Your markets, you see them, they're very sensitive and fragile, so it can go in any direction. So we just need to be mentally all, from the fintech, from the investors, prepared for shaky rides coming up, right? So, well, whatever you take as resources to make sure you go through this change, yeah.
So one of the things that it's very interesting to think about is, let's assume that there is an overvaluation. In your mind, what are the most likely triggers of a reassessment of value? And Donald, I'd like you to take that on, please.
I'd say, having gone through the first 2, it's usually like something that you're not planning for, some external shock that comes in. Yeah, it's called life, and so I think it's hard to predict. I would say, it's interesting. We're investors in a very large hedge fund called Bridgewater. If you look at what Bridgewater's been talking about recently, there's a strong belief there that there's a paradigm shift coming, and that today kind of looks a lot like the 1930s. And if you were to read into sort of a lot of the statements coming out of them, it would sort of imply, could we have some problem with China between the U.S. and China, and could that lead to like currency devaluation? And so we begin to think about, well, gee, if something like that happens, should we be investing in the U.S. market? Should we be in other markets? And so we've actually started investing in overseas markets as a result. So I think something will happen. We just can't predict what it'll be.
But you don't have a specific view in mind of what that trigger could be. Would it be a change, for example, interest rates changing and therefore finding other sources of investment for institutional investors? Would that trigger move away from VC into other areas?
I think it could, but the one thing with the VC is typically you have LPs that are locked in like these 10-year fund vehicles, and so the one thing we did see in the dot-com bubble was something that you're right that like from 1 month to the next, like the music stopped, and what that meant was that suddenly LPs saw their equity markets falling. That meant that their commitments to venture capital were over-allocated. They were over-indexed. They went from like 5 to 7% of assets committed to the category. And we saw LPs just walk away from venture funds and say, I know that I've made my first couple of capital calls. I've invested 20 million. I'm just going to write it off, and I'm not going to meet any more commitments. And I think it takes a strong external shock to create that type of thing. I don't think that's going to happen. Personally, I don't think that's going to happen this time around, but I do think something's going to change.
So strong external shock, Julien. What do you think?
For me, I mean, it will come from the later stage companies. If some do not deliver as planned, then they will suffer, and if they suffer, then the late stage funds will be more careful on the earlier stage companies and so on. So I think it will more come from later stage companies not delivering. This is my feeling.
What's your definition of not delivering? Because if we look at what's happening, there was an interesting article in the FT a few weeks ago that was showing where the money goes in some of these unicorns, and it was showing very clearly that, for example, Revolut doubled its marketing spend after they did the 100+ million fundraising. So where is this going to come, this repositioning? Because if they have the cash coming through, they're going to pay for customers ongoing, and the numbers will grow. At some point, what is in your mind the metric that will say growth has stopped?
I mean, if you look at Revolut, they are around 10 million users today. They want to get to 100 million in the next 3 years or 4 years. So what they sell to their investors today for the round they are willing to do is they will double every year the number of users at least, or the revenues. What can go wrong? First, they put more money into customer acquisition, and there the unit economics start to become crazy. Instead of acquiring customers for, let's say, 30 euros, it costs them 70, 80, 100 euros to acquire the customers. Then obviously you can see that the model doesn't fly, and so people will not invest in the next round. So I think this kind of stuff can happen, not delivering because your unit economics are not resisting to the growth you want to deliver.
Benoit, could you give your views, and then we'll open to the public if there's any questions. Just make
Yes, I see this also happening, and then the same story of going for the winner takes it all. So you go there, and then you just also want to prevent that the others are going to be there, right? So you may, and you see now you might have 2 or 3 of them going, but if they have to, at one point of time, the unit economics need to make sense also in the long term, right? Because the cost acquisition is by definition higher every time, But I think the people moving easily are there, but eventually, what kind of products are there? You were saying that customers are staying in their banks and all that, but what are the kind of products which effectively will be moved on a recurring basis so that the revenues are also recurring on the other side? Because opening an account, this is the nice, easy part, right? But I think keeping the customer and acquiring at the price which is lower than the cost you need to make it alive, this is just the basic economics for centuries, right? So we'll face this. But I also would point at the external shock, because I think this is the only way things will dramatically change. I think as human beings, we only understand when the situation is just really tragic, right? We're just positively wired. We want to believe it's possible. Trees are growing until you're really facing the reality of but I think then it's a big external shock, right? You can't avoid.
Thank you. Wise words.
Sorry,
Wise words. Any questions in the public?
Let me go ahead and shout it. You can repeat it. My quick question is this. Is fintech winner take it all? Because a lot of the valuations assume that, like in other parts of the with the gig economy, there is a winner and the winner takes it all, and that boosts the valuation. Banking is regulated, fintech is regulated, and there are, usually most countries have multiple banks. So is this even a winner-take-it-all play? I know it's a broad question, maybe you can answer it.
It might depend on which kind of fintech you're looking at, right? B2B, B2C, B2B2C, whatever. But I think in the consumer world, I think yes, I don't think there is place for many people. You see the power of attraction of those platforms. So we see them, in the Facebook and in the non-financial market. But I think this is the way people are going. They just aggregate into one very attractive pool. But on the other sides, I think B2B probably not, but I think the ambition of a B2B business is also somehow different. It might also go and be sold to an incumbent in the midterm, right? So there you might find different solutions.
Yeah, I think even some B2B businesses like payments, at the end, for example, this is clearly a winner takes all. This is a platform play. The more customer you put on the platform, the better you are. So, these kind of businesses are clearly like a winner takes all.
Does WorldPay know that?
Yeah, I would just add to that to say, I think what we've seen a lot of times as you've had technology kind of revolutionize markets is top three take most. And so the top three platforms having 80% of the market share would not surprise me at all.
Any other questions? So we're about to close. Can you give us one by one what are your biggest fear for and biggest advice you have for other investors looking in the next few years?
I would say one of the things we've seen, especially if you're in sort of a newer fund coming on the market, is to specialize, because it's such a hyper-competitive market that the only way you will work with the best entrepreneurs is if you can actually genuinely help them in some way, and that to me implies focus and specialization at the fund level.
So the advice for the startup companies we have in the portfolio are like, first, do not change anything before the bubble burst, because there is fast growth, like continue to grow fast. But keep in mind that it can happen. So keep in mind that one day you may want to be able to become profitable in a year. So you have a plan to become profitable in a year if it's required.
And I think in line also with this is just stick to your plan. And I think don't focus too much on what is or could potentially, maybe one day happen, and just look at the reality and just stick to that. But also don't be fooled and make sure that you have enough to go through this, but keep on the long term, because those changes take time. So patience is also something which we need the impatience to be patient.
So focus, and as one of the founders at Intel said, only the paranoid survive, so be worried about what comes next. Now, a point I'd like to leave you all with is, if there is a bubble, this doesn't mean that fintech is not a real thing. Banking as we know it today will not survive this change, so we will have to change. Now, is it going to be the fintechs that are valued billions are going to do that, or is it going to be a startup that Benoit has invested in that is going to change the world? See, I give you a good plug. The industry's changed and it's fundamental, so just place your bets in the right place. Thank you very much, everybody.